So you bought your first house and you're currently sitting at like a 6.75%+ rate because you bought in the last couple of years and maybe the timing wasn't great. But you were also told to date the rate and marry the house, and that rates are going to drop soon, so you can just refi right out of it. Well, most likely you're still sitting in that 6.75% rate and you probably haven't refinanced yet, and that's why the heck you're watching this video. So now you're sitting in a place where it's 2025. Headlines everywhere are saying that feds are about to cut the rate, that we'll see 5% by the middle of next year, that the overnight Fed rate is going to be cut, and everything's going to get way better. So now that rates are in the mid to low sixes, depending whether you're conventional or FHA, possibly even the high fives right now with FHA and VA, you're questioning, do I refinance now or do I wait another 6 to 8 months if those rates really do hit that 5%? Now, the first thing I want to remind you of is that last year in September, rates were at the lowest we'd seen in multiple years. Then the Fed cut the rate, and then mortgage rates shot up. Now, they were focusing the Fed rate off inflation and dropping the Fed rate. The Fed rate does not correlate directly to the mortgage rates, and that's something I'd like to remind everybody. I would be stoked if mortgage rates hit 5% next year. A lot of people are talking about it. I personally think they're gonna get lower. But if you would have asked me a year ago what I thought was going to happen, I would have told you we would have been in the 5% by March of this year. So I would have been very wrong. And a lot of people were with me on that. So reminder as we look into this that what we thought was going to happen last year didn't happen. And so I don't want to sit here and tell you 5% is going to happen next year because realistically, with the time I've spent in this business, I don't know what's going to happen. And I'd love to see those mid-5, low 5% rates, but I don't necessarily believe it with the way everything has been running. With that being said, you can do some math and figure out if a refinance right now is actually going to make enough sense for you to pull the trigger now on that refi, even if rates do get down to the fives next year. Now, first off, what does a refinance actually cost? Now, in general, appraisals around $600 to $650, at least in California. Title and escrow fees usually were anywhere from $1,500 to $2,500-ish, depending on the size of the house, depending on the county you're in, depending on which title company you use. So, realistically, anywhere $1,500, let's say $3,000 as a max. And on top of that, you have your lender fees and underwriting fees, usually anywhere from $1,000 to $2,500. It's kind of on the high side, but in general, and then plus you're looking at any sort of prepaid, like prepaid taxes and insurance, plus any other sort of miscellaneous. So in general, total usually is around maybe $4,000, maybe $5,000 on most refinances is just straight fees that you're paying. Now, the other part I always like to include is escrow and impound accounts. If you own less than 10% of your house, you are legally required to have impound accounts. And what are impound accounts? If you bought a house, you should know this. Hopefully your loan officer talked over it with you. Basically, your impound accounts is something you pay on a monthly basis that go into a separate account that pay your taxes and insurance. When you refinance a loan, you're paying off a previous loan, which also means that escrow account that was attached to the previous loan is closed. So now your escrow impound accounts that go to pay your taxes and insurance are actually have to be repaid. You repay into those accounts and you'll get a check back for whatever was in those accounts. Now, there are some times you can choose to either bypass these accounts if you own more than 10% of the home and pay your insurance and your taxes out of pocket, or if you are with a servicer that is able to refinance you or a lender that's able to refinance through the same servicer, you can actually transfer your impound accounts from one loan to the next, so you're not having to pay it out of pocket. So depending which option you go with, if the impound accounts have $4,000 in it, you may need to actually add an extra $4,000 into your refinance costs, and then you'll get a check back for that $4,000. Or if you can transfer those over, I don't personally count those as costs when you're refinancing, because realistically, you get a check back for whatever the escrow amount that was previously in your impound accounts was, and you can use that to just pay straight on your principal. Now, with that being said, my rule of thumb, usually when you're looking at a refinance, is around 1% of a difference. So if you're at a 7.25, once you hit the 6.25 is usually where it starts to make sense. And here's why. With most California prices, that 1% is going to save you anywhere from $150 to about $300 a month. If you're in a higher priced home, that's going to be even more than that, depending on your loan amount. So a little bit of simple math. Let's say the cost to refi is $4,000. That's your lender, your title, your escrow, your prepaid taxes, everything except for your impound accounts, going to cost on average around $4,000. But you're getting a 1% savings on your interest rate. So from a 7.25 to a 6.25. And let's say you're saving $295 a month. The break even on that extra $4,000, because when you refinance, if you haven't refinanced, if your first home was bought in the last couple of years and you haven't yet to refinance, when you refi, you don't pay it out of pocket. You actually can wrap that number back into the loan. So you can wrap that $4,000 back into the loan, but you're saving $295 a month. It's going to take about 14 months for you to break even. So realistically, unless you refinance again in the next 14 months, most likely it was worthwhile to save what you saved. Now, the better question I ask a lot of clients is, how much do you need that money? Monthly payment, being able to save yourself $300 a month. You also, when you refinance, just like when you bought the house, because the way a refi works, when you pay for it, you're paying your next month's payment included in that cost and the loan cost. So you're actually skipping a month's mortgage payment. Now, between those two things, between skipping that, $2,500, $3,000, $3,500 a month mortgage payment, plus getting back, maybe $300 a month, is that a worthwhile reason for you to refinance? You have to ask those questions and say, okay, depending on the break even, if rates do come down in a year, will I want to refinance again then? If they go from now you're at a 7.25, you've refinanced into a 6.25, next year they come down to a 5.25. It might even make sense for you to refi now and again in a year, as opposed to just waiting it out for the best rate possible. Yes, you're spending a little bit more money in the back end on the loan fees, but keep in mind when you refinance, if you refinance a 30-year loan, that $4,000 you're paying for the fees is cost over 30 years. I mean, you're talking a difference on that $4,000, adding that back into the loan, maybe $25 to $30 a month that you're paying. Now, I'm not saying you should just refinance every minute and just get yourself constantly into that idea of, having the loan costs included in there. But realistically, it could make sense for you to refi now, depending on your costs. So let's finalize this and talk about what you're seeing in the headlines. Now, realistically, will mortgage rates hit 5% by the end of 2025? No, not by the end of 2025. I don't think so. I think we'll see low sixes by 2025, but I don't think we'll see anything in the 5%, especially not for conventional rates. Now, the second part of this is the Fed likely to cut rates? Yes, based on recent data, they are very likely to cut rates. But if you look back to what happened in September of last year, the Fed rate cut does not mean mortgage rates will come down. We can hope all we want, but mortgage rates are usually tied pretty close to the 10-year Treasury bond, not to the Fed overnight interest rate, which is what you see being cut. So the question for you becomes this, are you saving enough? Have you hit 3/4, maybe 1%, maybe 1.25%? Are you saving enough money monthly to make that refinance worth it? Is that extra $200, $250, $300 beneficial to you in your financial situation? Because if so, if maybe you have some other debt and you say, hey, I could drop my interest rate 1% and I can use that money, that extra $300 to start paying off debt a little quicker, or I could really use that because my kid's going to start going to school and I need to pay for things. Those are the questions you should ask. Is not necessarily, is this the best time? Is the rates the lowest I'm ever going to see? Because realistically, we're going to see rates continue to come down. We just don't know when they're going to hit a time that's really that low. And also take into account last year when the rates came back up, there were a lot of people that told me they didn't want to refinance a year ago because the rates were on their way down and they thought rates are going to hit 5% by the middle of 2025. I'll just refinance that. Then they lost their opportunity because rates shot back up. Now they're still stuck at that higher payment when they could have come down and saved a couple $100 a month for the last year when rates still haven't come down. And on the upside, if they do drop more in the next 12 months, you can just refinance again. And just think about the cost of that. If you wait another year and rates don't come down 1%, you might have just cost yourself $3,000, $4,000 in monthly payments alone, just in interest. So if you are sitting at that 6.75% FHA, 7.5% conventional, I absolutely recommend you reach out and talk to your mortgage professional. Now is the time to run your numbers before there's any more economic craziness. See what you qualify for, see what your break even is, because if you can't break even, then it won't make sense. And I wouldn't recommend personally paying down a rate right now, trying to get yourself into that 5%, because most likely when rates do drop, you're just going to have already a lower amount. So the cheaper you keep that break even rate, if you're not paying points for the refi, most likely the better it is for you. And keep in mind with everything, real numbers make real decisions. So don't go making any decisions till you've talked to a real professional and had a conversation about break-even point rate, monthly payment. But those real numbers are what's going to help you figure out what actually makes sense financially for your future.